Welcome to the stock market update. It's Monday, July 25th, and there's a lot to talk about. Let's not sugarcoat things. This is an important week for the markets. Definitely the most important for the quarter. You could argue that it's the most important week for the year. The Fed will raise rates. The two largest U.S. companies will report earnings. GDP data will come out. Are we in a recession? And stocks will try to bounce back from Friday's losses. In this update, we'll review what you need to know heading into the week and stocks on the move. But before we get started, today is Monday. And if this is your first time here, my name is Mark Hodge and I'm head coach at Rockwell Trading. On a typical morning, Rockwell Trading's founder Markus is with me, and with watchful eyes and almost 50 years of trading experience, we sift through a mountain of news websites, newsletters, and reports, and we take the most important news and go live right here to share with you what you need to know as you head into your trading day. Now, we've mentioned it before. I know that some people have been a little frustrated with it, but we do have a slightly different schedule with Markus being out of the office this July. But I'll be doing weekly updates on Mondays and recaps on Friday to keep you in the loop and to make sure that you know what you need to know as you approach the markets. For those of you that watch our updates, well, thank you, and we appreciate the likes. If this is your first time, I know it can be overwhelming, so we'll post a video just for you in the description, which is a great place to get started. And let's get to the charts here. Let's go right in. This is the S&P 500. S&P 500 had a decent week last week. It was looking pretty strong heading into Friday's session. Here we see that we had a couple of nice up days there. We crossed the 50-day moving average, closed above it, and we were looking pretty strong going into Friday. But stocks did sell off on Friday, and the S&P snapped a 3-day win streak. This, was something that took place really across the board here. If we look at the NASDAQ, the Dow first, the Dow also higher for a couple of days, 3-day win streak, closing above its 50-day moving average, opening higher on Friday, and then pulling back. And here we have the NASDAQ doing the exact same, closing above its 50-day moving average, and then pulling back here on Friday. NASDAQ really leading the indices with a 1.9% loss. The S&P was down 0.9%. The Dow down just 0.4%. But for the week, it was a decent week in spite of Friday's pullback. If we look at the S&P closed 2.6% higher for the week, and the Dow closed 2% higher for the week, and the NASDAQ was off a little bit. It was up 3.3% for the week. So in spite of the almost 2% drop on Friday, still a decent week for the markets. Now, what's moving the markets? Well, this week is a biggie. We have a huge week for tech earnings. There's also advanced GDP, and traders will be definitely discussing the R word, recession, because of that. But arguably, the most important will be the Fed's decision on interest rates and that Fed statement. Now, let's first tackle earnings. So far, this earnings season actually has been pretty positive. According to Refinitiv, 75.5% of the S&P 500 have reported better than expected earnings. That could be argued to be a little bit of a surprise, right? Are we seeing a recession? Are we seeing a slowdown? How is it impacting earnings? And so far, it hasn't really affected earnings that much. Now, today is a relatively slow day for earnings, but it picks up tomorrow. We're going to have Microsoft, one of the U.S. Largest companies, as well as Apple reporting this week. But on Tuesday, we have Microsoft, we have Alphabet, and we have McDonald's, Coca-Cola, and General Motors. And then on Wednesday, we have Facebook or Meta, Shopify, Boeing, Ford, and Qualcomm. And then on Thursday, the 28th, we have Apple, Amazon, and Comcast. And then on Friday, we have ExxonMobil and Chevron. Those are just some of the bigger names reporting this week. We can take a look at what's going on with Microsoft, see where it's at. Microsoft, really, it looks like traders are anxiously awaiting earnings. Look at this chart here. After a pretty well, let's actually go back to a daily. Even on a daily, the weekly looked a little more sideways, but on a daily, we see that we're making higher lows on these dips, and we're seeing lower highs, and just kind of creating this triangle here, uh, getting into a tighter range. So traders definitely looking at earnings, waiting for earnings. And again, this is going to be released for Microsoft tomorrow. We could also take a look at Apple. Apple uh, investors wanting to hear about iPhone sales, hoping that iPhone sales are still strong and that there's strong demand. But that forward-looking guidance for Apple is definitely gonna be in the spotlight. Apple, we see that uh, Apple popped above its 50-day moving average back here early July and has been moving higher, down a little bit on Friday, but looking a little more bullish compared to what we saw with Microsoft. So earnings in the spotlight, and this is a huge week for tech. But there's also the Fed. So just a few weeks ago, traders were expecting a 100 basis point hike after CPI data. That jumped. The probabilities went crazy there. But now a 75 basis point hike is actually priced in and expected. So a surprise higher or lower would be a shock to the market at this point. But aside from the actual interest rate decision, traders will be looking for the Fed's guidance during the Fed statement and press conference, trying to figure out exactly what the Fed has planned. They won't meet in August, so the next Fed meeting after this week is going to be September 21st. And traders want to know if the Fed plans to aggressively raise rates the rest of the year or if things will slow down. And this is where, if we look at the Fed funds tool, so looking at Fed funds, we actually see that uh, the probability now priced in for a 75 basis point hike is 77.5, and a 100 basis point hike still a decent expectation there at 22.5. Normally, as we get closer to the Fed statement, you see that the probabilities shift. Typically they could be 50-50 for sure, but you generally see the traders start to have a clear expectation. It's definitely pointing to the 75 basis point hike, but there's still some room for 100 basis points at this point in time. Now, if we look at the probabilities here, we see that after this decision, after this 75 basis point hike, then again, we don't have a Fed meeting in August. Then there's one towards the end of September. There, traders are expecting a 50 basis point hike. So going back to 50, and then no meeting in October, a meeting in November where they expect 50 basis hike. And so you see that it looks like traders are really expecting rates to be at about 3.25, 3.5 by the end of the year, and then slowing down. So that's one of the things that traders are going to be listening for. Will the Fed be more aggressive with their forward-looking comments? Do they feel that because of the employment situation being strong still, and last retail sales actually being strong, do they feel that the market can handle this, or do they need to slow down? What's their expectation for inflation? Is it peaking at this point, or do they really need to continue to be aggressive? And this is where you have the hawkish versus the dovish conversation. Will the Fed be more hawkish, where they're really aggressive with hikes and potentially slowing the economy? Or will they be more dovish, where they are supporting the economy? So that is to be seen, but at least at this point, traders are factoring in a 75 basis point hike, although a 100 basis point hike is still slightly on the table. Now, advanced GDP is another one. Let's go ahead and look at the economic calendar here. And there are a few items on the economic calendar. Today, nothing. Tomorrow is relatively light. You have consumer confidence highlighted as a red flag report. However, because of the more important reports, Wednesday's Fed statement, Fed press conference, and also advanced GDP, those are going to be the real biggies. So advanced GDP. Well, this is where if GDP is negative, the discussion will turn to recession talk again. Typically speaking, a recession is defined as two negative GDP quarters, and we've already had one. So, will this be the second? We'll see. Right now, the forecast is slightly positive. But technically speaking, even though GDP being negative for two consecutive quarters is considered to be a recessionary scenario, technically speaking, an official recession would be declared by the National Bureau of Economic Research, and this actually considers a number of factors, specifically employment in addition to GDP. And as mentioned earlier, right now earnings are not pointing to a recession, with earnings actually expected to be up 9.2% instead of down. Typically, when you have a recession, even if you have a soft landing and it's just temporary, you see earnings are falling, and earnings are down approximately 13%. Right now, they're expected to be up 9.2%. So this is the third here. So what's moving the market? Earnings. This week it's going to be the Fed, and then we have this looming advanced GDP. Will it be positive? Will there be a sigh of relief there, or will it be negative, where now everybody's talking recession? And again, we'll just have to wait and see there. A few movers here. Let's go back to the charts and let's look at Snap. I mean, this is where on Friday Snap was just crushed. Snap down 39%. Here, let me slide that over. You see that, I mean, gosh, you have to go back to, well, the pandemic to see where Snap was last trading under $10 a share. So running up to 80 at the peak of the post-pandemic highs, down to 996 yesterday, down another 3.6%. They were downgraded by a few different companies, but Morgan Stanley actually double downgraded the stock because of the continued threat of TikTok to Snap and their business, and also potential ad losses in a difficult economic environment. So Snap just looking like a ugly chart here. A few movers here because of earnings. Let's look at Newmont. And Newmont down 3.5%. They slid in pre-market trading after reporting worse than expected second quarter, or lower than expected second quarter earnings. Profit was down actually about 41% from a year ago, hurt by a drop in gold prices. So they reported, but really a slow day, although it will be a busy week, slow day for earnings. I want to go to Marriott here because we talked about this last week. Talking about open trades, open positions that I am in right now. I am in Marriott. I own shares at 152.50. I have collected some decent premium on this one. I am in LVS. I am also in AMD, and I have a small position in Ride. So right now, these are my wheel trades. And I mentioned last week that I want to get 60% if I'm going to roll those calls. And I didn't have to do anything because yesterday with Marriott closing, or Friday with Marriott closing at 150.91, those calls expired worthless. So I didn't have to, I wasn't called away. If they had closed above 152.50, I would be called away. But when we sell calls, our shares can get called away, or if it closes lower, they expire worthless. And that's what happened on Friday. So I chose not to roll. And I mentioned that really there's two reasons why I wasn't looking to roll, but also why I'm looking to move on from this one. One is we've now established a new range. I liked where I got into this trade, but it looked like there could be some support at these levels, and we fell, and now we've established a new range. So we're back towards my assignment, but with this new range, and in this type of market, I'm leaning towards letting this go. And if I want to trade Marriott again, maybe I could sell puts down here, right? Once we have this new range, if it pulls back, maybe that's a better level. But we also have earnings being released, and earnings will be released on August 2nd. So really 2 weeks here, I don't need to just panic and get out of this one, but uh, owning shares, if I could sell calls for this Friday, see what happens, collect that premium. I can also watch it, and if this thing rallies, I could just decide to close, especially if we get above 152.50 where I own shares at. I could just close the trade for a profit, and that's what I'm leaning towards doing, especially if we make a move here. Right now, no pre-market trades, so I'm not seeing any pre-market quotes. The futures markets are slightly positive here. Even the S&P 0.2%, Dow 0.3%, Nasdaq 0.1%. So we're seeing a possible, or we're seeing a positive start at least for now. Uh, Leaning towards closing Marriott if I could close it above 140 or 152.50. Although I'm not totally against selling calls for this Friday if there's some really nice premium and that will bring my break even down. So I'll need to see exactly where we're at the open, but I did not roll last week, so I just own shares and I need to see where we're at. Considering the ROI on that premium, that would bring down my break even, but keep me locked in for the week. Or if I just let this go, and I'll see what happens when markets open up. So that's going to do it for today's stock market update. Again, busy week, slow week for the economic calendar and earnings, at least for this morning. And then things pick up with the economic calendar or earnings tomorrow. We have the Fed and advanced GDP. So busy, busy week. So until Friday, when I'll be back here doing a stock market update, have a great trading day, a great rest of your week, and happy trading, everybody.